Where to begin? Thank you for your patience as we work through our live coverage of the PDAC last week. At such a momentous time, which increasingly, as Frik Els points out, in our feature interview on battery metals and what is happening in the electric vehicle industry, super fascinating interview with Frik Els coming up, editor-at-large at mining.com. But as Frik pointed out, it's just all turning into geopolitics, isn't it? So there is a ton going on. Hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli, who will do everything he possibly can to catch us up on the last 2 weeks of what's happened. Now, there is kind of an interesting side to this, because we're going to see, interestingly, how, say, metal prices pretty flat when you look 2 weeks on. It's quite interesting. It's like the volatility, it almost reduces the volatility of our understanding by taking 2 weeks from our last in-depth show, so to speak. Of course, at PDAC doing interviews with a whole bunch of very interesting people, by the way, and I hope you enjoyed those interviews. By taking 2 weeks, we almost remove the volatility, so to speak, and get, I would argue, potentially, at least a clearer picture, one hopes. So let's begin. Now, it seems to me that as far as the metals markets are concerned, the biggest issue with the war in the Middle East, or West Asia, as is increasingly called these days, aluminum is having an issue. Apparently, 9 to 10% of the aluminum supply comes out of the Middle East. So our first headline to get us started here, and there is a ton to get through, as you can imagine, Aluminum Bahrain declares force majeure on contracts. Now, force majeure, for those that don't know, basically means you can break a contract based on an act of God, shall we say. Something out of your control allows you to break a contract. That is force majeure, of course, français. So this is March 4th. Aluminum Bahrain, which runs one of the world's biggest smelters, warned customers on Wednesday, so about a week ago, it had halted shipments due to the widening Middle East conflict, exacerbating supply concerns after a Qatari smelter shut down a day earlier. Aluminum prices jumped as much as 5.1% on the news, their strongest since April 2022. And analysts said prices could go still higher. So we're going to see what happens. Just jumping, though, to that Qatar shutdown. That was March 3rd, the day before Qatar smelter shutdown exacerbates Iran war aluminum fears. And that is Reuters via mining.com. And so that is what Aluminum Bahrain is referring to, is the shutdown of this Qatar smelter. And as it says here, the impact of the U.S.-Israeli attacks on Iran on the aluminum sector deepened on Tuesday, so the day before, after Qatari smelter Qatalum began to shut down and shareholder Norsk Hydro issued a force majeure to customers. And we have a quote from Norsk Hydro, quote, "The decision to shut down was made after the company's gas supplier informed it of a forthcoming suspension of its gas supplies." Hydro, which holds 50% of the Qatalum joint venture, said in a statement on Tuesday. So that is a week ago. Now, if we bring us up to date, the aluminum price rose on that news, and then it began to moderate. And so here is the update from March 9th, yesterday. Aluminum price slips from multi-year high as market turmoil hits metals. This Bloomberg News on March 9th via mining.com. Aluminum fell amid a broad sell-off across financial markets after earlier touching the highest in almost 4 years as escalating hostilities in the Middle East hit supplies from the region. The metal rose as much as 2.8% in London before turning lower as a slump in equity markets and a stronger dollar created headwinds for industrial markets. Nickel pared earlier losses after 4 Indonesian plants halted output following a deadly landslide last month. Aluminum jumped almost 10% last week, the most in 3 years, as the war curtailed shipments from the Persian Gulf, which accounts for about 9% of global supply. Buyers in the U.S. rushed to secure alternative cargoes from Asia after at least 2 major smelters in the Middle East, one in Qatar, another in Bahrain, were forced to suspend deliveries. And the reason is being attributed to the Strait of Hormuz. And according to ALBA, which is Aluminum Bahrain, quote, "It's because what's happening in the Strait of Hormuz, we're not able to ship. So we're producing, but the metal is here in Alba. The spokesperson said, and continues, quote, "The force majeure is not due to any disruption or damage to the smelter facility. The team is working intensively on identifying alternative shipping solutions to minimize the impact." Now, bringing us up to date then, we have a story from Reuters yesterday. Mideast-bound bauxite alumina vessels divert due to Hormuz blockage. So this is causing all kinds of turmoil in the global aluminum market, and we have another update. This is Bloomberg News via mining.com on March 6th. U.S. aluminum buyers hunt for alternatives as Iran war upends global supply. Aluminum buyers in the U.S. are rushing to secure alternative supplies from Asia as the war on Iran disrupts a major foreign source, a development that threatens to hike the cost of the metal used in auto parts, appliances, and beverage cans. An effective halt on shipment through the Strait of Hormuz has already prompted two top producers in the region, Qatar and Bahrain, to suspend deliveries to customers. The U.S. relies heavily on imports, with the Middle East supplying nearly a fifth of its aluminum last year, according to government data. Andy Massey of Bonnell Aluminum said the company, which molds aluminum into shapes that can be used in products including cars and construction materials, is looking to source the metal from markets such as India and Australia. The Georgia-based manufacturer may even tap the domestic market for near-term deliveries if there's metal that isn't tied up in annual contracts. Quote, "We're all scrambling to figure out what's happening on the ground. I need to find alternative supplies over the next 2 days. Fast. And make sure we don't overpay." Sounds like Massey is under pressure from that quote. And then we have another quote from RM Metals Vice President Sam Desai. Quote, "Korea is a great option right now," said Desai, adding that his firm is also looking at supplies from Northern Europe. Quote, "It's become very hard because the cost of aluminum itself has gone up since the Iran war started." So, aluminum market in turmoil with the closing of the Strait of Hormuz. And further, we have a column from Reuters, courtesy of Andy Home, one of our favorites over here. And he has an interesting stat in his column, which is called "Iran War Exposes Fragility of Western Aluminum Market," and that is by Reuters on mining.com. And this was an interesting line. "The continued closure of the Strait of Hormuz risks further disruption to a regional production hub that accounts for 23% of non-Chinese supply." So 9% of the global supply, but 23% of non-Chinese supply. Very interesting. As it says, aluminum has historically been cushioned against such unforeseen supply hits by high inventory and excess smelter capacity in China, where producers would lift run rates at the first sign of rising prices. Inventory cover is now much reduced, and China no longer has much spare capacity to flex, rendering the market much more sensitive to the sort of disruption currently unfolding in the Middle East. And all these complaints of oversupply. Now, where are we? So China may not be able to cushion the blow. Finally, on aluminum, we have this headline from Bloomberg News via mining.com on March 6th. Aluminum supply shock brings massive options bet into the money. A huge aluminum options trade has come into the money this week as the war in Iran sparked a sharp rally in prices, delivering a windfall after the appearance of the position stunned dealers last week. Aluminum prices have rallied as much as 9% this week, hitting a 4-year high of $3,418 a ton on Wednesday after Aluminum Bahrain, one of the world's top producers, suspended sales due to the effective halt of shipping through the Strait of Hormuz. Qatar's state-owned producer has been forced to stop production a day earlier due to a domestic shortage of gas, and traders have warned of worldwide disruptions to supply unless the vital waterway reopens soon. So apparently, the upfront cost of this bet was $40 million, and it looks like it delivered a $133 million windfall. So interesting detail there. Continuing on with the Strait of Hormuz, Gulf disruption squeezes Indonesia nickel makers' sulfur supply. This is Reuters via mining.com on March 6th. Nickel makers in Indonesia, reliant on the Middle East for 75% of the sulfur they use, may have to cut production. As Gulf shipping is increasingly disrupted by the conflict in the region, analysts said. Sulfur is used to make sulfuric acid, which is essential for leaching metals from ore in nickel refining and copper processing, with some copper producers in Africa potentially facing similar problems. The Middle East accounted for around 24% of global sulfur production at 83 million metric tons last year, according to the U.S. Geological Survey. But disruption to shipping in the Strait of Hormuz as a result of U.S. and Israeli attacks on Iran and Tehran's widening retaliation is threatening to squeeze supplies. Indonesia, home to more than 50% of global nickel production, imports roughly 3/4 of its sulfur from the Middle East, according to Peter Harrison, analyst at consultancy CRU. The country's nickel is used mostly to make stainless steel. So all sorts of repercussions here from the closing of this key shipping lane. Another interesting story, gold shipments stranded in Dubai as Iran war grounds flights. It's Bloomberg News on March 3rd. The mass cancellation of flights to and from bullion hub Dubai has left traders unable to move their metal, highlighting the potential bottlenecks to physical gold flows that could emerge from war in the Middle East. And it looked like, at least at certain points, that Bitcoin had caught a bid, interestingly, as you start facing physical limitations. The United Arab Emirates is an important spoke in the global gold market, refining and exporting bullion to buyers across Asia, as well as serving as a conduit for shipments from Switzerland and London. An unprecedented wave of Iranian missile fire over the weekend led the country to partially close its airspace and suspend flights in Dubai, grounding shipments of gold and silver carried in the cargo holds of passenger aircraft. So, interesting detail there. Another headline, gold stuck in Dubai is being sold at a discount as war widens, and this is also from March 6, which is Friday. This is Bloomberg News via mining.com. Gold is being offered at a steep discount in Dubai as the war in the Middle East grounds flights and hampers suppliers' ability to move bullion out of the key trading hub. Many buyers have stepped back from new orders, unwilling to pay exceptionally high shipping and insurance costs with no guarantee of prompt delivery. As a result, rather than paying indefinitely for storage and funding, traders are offering discounts of as much as $30 an ounce to the global benchmark in London, according to people with knowledge of the matter who asked not to be named discussing market information. Many shipments remain stranded on Friday, the people said, although some bullion has been loaded onto flights leaving Dubai from the middle of this week. So interesting, and another story came out at this time on March 3rd. Singapore taps JP Morgan UBS to push regional gold hub ambition. And you can read the whole story on Bloomberg News via mining.com as we continue to surf through the headlines here. Here's another one. Polish central bank chief weighs gold sales to fund defense. That is March 5th, Bloomberg News via mining.com. As we move to the Financial Times, with an interesting story here on Germany seeking to shore up critical minerals, and this is kind of an issue. If everybody starts to stockpile at the same time, what is going to happen here? It hasn't gone crazy yet. Here's the headline. Germany seeks to emulate Japan in shoring up critical minerals. BMW and Rheinmetall push for joint purchasing of raw materials to reduce reliance on China. And this by Lawrence Piddle, Sebastian Ash, Leo Lewis, and Harry Dempsey. On March 9th, yesterday, Germany's industrial giants are pushing for a Japanese-style trading house to secure supplies of critical raw materials in a bid to bypass China's stranglehold on rare earths. Kind of an interesting question. I mean, if China is creating 99% of the heavy rare earths, I'm not sure how a trading house solves that, but I'm sure they have strategy there. Carmaker BMW is among those working with Germany's automotive lobby and defense industry representatives on the concept, which could be supported financially by the German government, according to people familiar with the plans. Arms maker Rheinmetall is also involved, one of the people said. The move is part of a long-term effort by Germany to emulate Japan in making joint purchases of critical minerals on behalf of industry to, quote, have more power in the market, said one of those involved in the plans. Scrolling down, there is skepticism in Germany of the merits of the idea. Quote, we in Germany are of the opinion that industry should make decisions by itself, said one of the people. Governments and the European Commission should restrict themselves to buffer stockpiles, end quote. German Chancellor Friedrich Merz discussed critical raw materials in a phone call this week with Japanese Prime Minister Sanae Takaichi. So, critical minerals remain at the top of the agenda, weirdly more than ever. If you thought it couldn't get any more intense, welcome to March 2026. Continuing on, Australia's Lynas revamps deal to supply rare earths to Japan. This is Reuters via MSN.com. Australia's Lynas Rare Earths has revamped its supply agreement with Japan Australia Rare Earths, securing a firm annual commitment for 5,000 tons of neodymium praseodymium, a key rare earth magnet material. Scrolling down, quote, sales above this minimum volume will be by mutual agreement and at no opportunity loss to Lynas, the company said in a statement. The deal keeps Lynas's total supply capacity at 7,200 tons per year through 2038, but locks in a $110 per kilogram floor price for the 5,000-ton annual commitment. If prices rise above $150 per kilogram, JARE gets 30% of the gain capped at $10 million per year. Quote, sales above the minimum volume will be by mutual agreement and at no opportunity loss to Lynas, the company said in a statement. Contingencies left, right, and center as supply chains scramble to deal with yesterday's problems as new problems arise on a weekly basis, perhaps daily. Another headline, MP Materials inks rare earth deal with mystery automaker. This is Bloomberg News on February 26th. MP Materials signed an enormous rare earth supply contract with an unidentified automaker and is pursuing similar deals for a magnet-making plant it plans to build in Texas. As we continue, another story from the Financial Times, UK's first commercial lithium plant opens in boost to domestic metals mining, and this by Camilla Hodgson in London. On February 26, the UK's first commercial-scale lithium plant has started operations as part of the country's efforts to secure its own supplies of the critical mineral. Geothermal Engineering's facility in Redruth, Cornwall, will begin by producing 100 tons of lithium a year, enough for about 2,000 electric vehicles. It will then aim to increase to 1,500 annual tons within a few years and to more than 18,000 annual tons over the next decade, in a scale-up that will require about £640 million. So a new lithium plant in England. Continuing on, another story from the Financial Times. Africa should not pick sides in minerals race, says Zambia. It's by Monica Mark on March 2nd. So Zambia, of course, a key country in the copper belt in Central Africa. Zambia is refusing to pick sides in the race between global powers for critical minerals, its president said, arguing that resource-rich African countries should resist pressure to align politically in exchange for investment. With copper prices still near record highs, Hakainde Hichilema told the FT that Africa's second biggest exporter of the red metal needs to focus on expanding its economy rather than choosing between Washington, Beijing, or Brussels amid intense demand for minerals. Quote, when I'm in Beijing, I'm not against Washington. When I'm in Washington, we're not against Beijing, he said in a recent interview. Quote, we want to make sure that we do business with anyone in a manner that will deliver mutual benefits. Last week, Felix Tshisekedi, president of the Democratic Republic of Congo, dismissed senior executives at state miner Jeka Mines after they opposed the sale of copper and cobalt producer Chemaf to a U.S.-backed consortium. The move underscored how strategic mineral deals are now intertwined with competition between Western and Chinese interests in Africa's most mineral-rich nation. So interesting as ever, continuing on, Niger terminates trio of gold mining deals, and this is African law and business. The government of Niger has announced the revocation of 3 gold mining and refining licenses effective the 3rd of March, citing breach of contract and a failure to honor commitments. And continuing on, another big story out of the FT, Mongolia presses Rio Tinto to rewrite unfair terms of $18 billion Oyu Tolgoi mine. And this by Leslie Hook in London on March 10th. Mongolia is seeking to renegotiate the, quote, unfair, end quote, commercial terms of Rio Tinto's giant $18 billion Oyu Tolgoi copper mine as rising prices for the metal and a recent electoral shift contribute to a growing political impetus to change the terms of the 17-year-old deal. Top Mongolian officials, including Prime Minister Jomboy Javin Sandanshadar, who took office last summer, are meeting this week in Ulaanbaatar with Rio executives, including head of copper Katie Jackson, to discuss the terms of the Oyu Tolgoi agreement. The Prime Minister warned Rio executives in a meeting on Monday that the current deal was, quote, unfair, and that this whole situation feels like the Mongolian people and the parliament are being deceived, end quote, according to video footage seen by the FT. So resource nationalism continues, and finally, an update on Mexico. Vizsla Silver puts out a press release. Of course, we've been following that story where 10 miners were abducted from their residences on site, seemingly in the middle of the night. 5 appeared dead, and now, tragically, 2 more have been announced by Vizsla, and that is on March 5th. Here is the press release. Vizsla Silver provides update on situation in Concordia. Vizsla Silver has been focused on supporting the families of the 10 colleagues taken from its project site in Concordia, as well as its employees through a time of pain, grief, and uncertainty. In recent days, 2 additional families have received confirmation that their loved one is deceased. 3 colleagues remain missing, and Vizsla Silver stands with all affected families during this profoundly difficult time. Michael Connert, president and CEO of Vizsla Silver, said, quote, "Our hearts are with the families who have lost loved ones and with those who continue to wait for answers. We remain focused on supporting the affected families and our team and on the continued efforts to locate those who are still missing." And there's another detail that is added to this in Mexico News Daily. And the headline there is 2 more Vizsla Silver miners identified as 3 remain missing in Sinaloa. The Federal Attorney General's Office, FGR, announced March 5th that forensic specialists have genetically identified 2 additional victims in the case of 10 employees of Canadian mining company Vizsla Silver who were abducted in Concordia, Sinaloa. 7 of the 10 workers who went missing on January 23rd have now been confirmed dead, with 3 remaining unaccounted for. So they had to genetically identify 2 of the workers. So big questions there. We were pointing out how perhaps this was extortion, but the strange thing about it is if this was extortion, which does not sound crazy at all considering that silver was at record prices, why did they kill everybody? Why did they kill everybody if this was extortion? Which makes one wonder, is this rival gangs and this was simply payback of some kind and trying to scare the miner? Hard to say. So the mystery continues at Vizsla Silver's mine in Sinaloa, Mexico. A tragic story, and one's heart goes out to the families. So a big show today as we continue our very real-world novel here. Today, I'm very pleased to welcome Frik Els, editor-at-large at mining.com. We go in depth on battery metals, electric vehicles, and batteries. Frik gives us a primer on what is happening in that market. So an exciting feature interview this episode. Also coming up, we have America's Gold and Silver for this week's Spotlight. And so we're going to hear all about what they're working on as well. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to America's Gold and Silver for this week's Spotlight. Joining us today, I'm very pleased to welcome for this week's Spotlight, Paul Hewitt, Chairman and CEO of America's Gold and Silver. Paul, welcome to the show.
Hey, Adrian, it's great to see you.
We were talking before the podcast about how you're involved in Klondex, and I remember Klondex so well. That was my era when I used to invest in the mining sector. One of the best performing ones. Tell us a little bit about the company. Tell us a little bit about your background.
Yeah, it's great to be here with America's Gold and Silver. This is by far the greatest company I've ever been part of in my career as CEO. I'm truly excited about what we've accomplished in a very short time frame. It's been a very exciting 12 months, Adrian. We got here. The first thing we did is we bought out Eric Sprott's 40% ownership in our flagship operation, the Galena mine. So we're based in predominantly Idaho in the Silver Valley district, one of the greatest silver districts you're going to find on the planet, surrounded by other operating mines like Lucky Friday. We've got sunshine around us. So we're in a great, great jurisdiction that has a lot to offer. One of the advantages we had is not a lot of drilling was done in this district. So that we're taking advantage of. We've also got a mine, Adrian, in Mexico that is doing absolutely amazing things. Our team there on the ground, led by Gabriel Soto, are doing some amazing things year after year. In fact, last year was a record year for production in our Mexican operations. Best year we've ever had since we've owned this company. And I've been here as chairman and CEO for a little over 12 months. But the company's been around for well over 16 years, and it's been revitalized by a new injection of capital. Over the last 12 months, we've raised anywhere just shy of $300 million in debt and equity. We've got a very, very strong balance sheet. We've just bought a second mine in Idaho, consolidating the district even further, taking advantage of our milling complex. We're in a very strong financial position in a very great jurisdiction at a great time to be producing silver.
Now, it's America's gold and silver. Are you primarily producing silver then? And can you give us a bit of a profile? Like, it sounds like there's 2 mines in Idaho and a producing mine in Mexico. Is that correct? Color it in for us if you can.
Sure, absolutely, Adrian. So we have actually 2 mines in Idaho. We've got the Galena complex, but the Galena complex is made up of a couple shafts. So there's the core shaft, there's the Galena shaft, and there's Caladay shaft. And Galena mine back in 2002 with one shaft actually produced 5 million ounces of silver on its own. Over the last 10 years, it's been producing about 1.2 million ounces of silver. It's been lacking cash. It really needed some money. And this investment that we put into it with the new team is really revitalizing it. So we've got the 3 shafts at the Galena, but then we've got the 4th complex, which is 8 miles away, the Crescent mine. We just bought that mine. It has 3 separate adits. So all 3 adits in the same mountain. We've restarted the Crescent mine. We've just put power into it. It's been dormant for over 15 years. Because it's so close, we're able to take the trucks and just haul the ore right from Crescent directly into our Galena plant, which is why we bought it, because there's so many synergies. We can take advantage of the synergies. And as you pointed out, the mine in Mexico, Adrian, is an operating mine. All our operations are actually operating mines. We began some very, very extensive exploration programs. One of the things that attracted me the most about this operation and why did I come? First and foremost, Eric Sprott, who I've known for a very long time and respect a tremendous amount, was a 40% shareholder in Galena Mine. He had asked me while I was still chairman and CEO of Karora, he had asked me to join as a technical advisor. So I was a technical advisor for about a year before selling Karora to Westgold. And during that time frame, I was speaking to our existing team and I said, guys, we really got to take advantage of this. If we raise the capital, we drill here. There hasn't been any drilling in Mexico or in the Silver Valley area in 10 years. And you're talking some of the best districts on the planet here. And you can already see in the 12 months we've been here, Adrian, some of the drill results we've had. We've had 2 new discoveries with the 34 vein. We're talking 3.4 meters wide of 983 grams. Last year, our mine, our Galena operation averaged right around 490 gram per ton silver. That's the 3rd highest in the world. That's very, very high grade, and grade matters. No matter where you are on the planet, whether you're mining gold, silver, and in this case, we're mining silver. But as you asked, what else are we mining? At our Galena complex, we have our silver ore, we have copper, we have antimony, we have a lot of lead, and we also have some gold. So we have 5 critical minerals that are on the US's critical mineral list. So that's a big advantage we have. We're fully permitted. We're in operation. We've got well over $135 million US in cash. We've got a $50 million line of credit behind us that has untapped, unused. And we're very excited about getting the mine back to what it used to be. We know it did 5 million ounces in 2002 with 1 shaft. Now, what do you think it can do with 3 shafts at Galena and then 3 other adits? Look, this thing here as a complex, we will get it to 5 million ounces, but pushing it to 5 to 7 to 10 million ounces, is that possible? Absolutely, it's within our realm because we have so much infrastructure. We just need to start taking advantage of it and start doing basic mining 101, going back to our roots and just saying, all right, let's build a mine plan, build a resource, good reserve, good mine plan, and then let's look at what this thing looks like as a massive complex and while we're drilling. As a company, Adrian, we're going to be going from, last year we had 5 drills, say, as a company. We're going to go from 5 to 15 to 20 drills. Imagine the drilling we're going to have in a district that hasn't had any drilling in 10 years. So honestly, I've never been more excited in my career. More than 80% of my net worth is in one stock. I have a wife and 7 kids, Adrian, and I foster an 8th one. So I'm quite busy. I'm not about to put everything into something that's a high risk. In fact, I put it into the safest thing in my lifetime. And I've explained that to my wife. We're putting our money, we're not betting it. We're putting it into the safest investment. We're putting it into ourselves and alongside our shareholders.
7 kids. Incredible.
Yeah.
We'll save that for the next interview, Paul.
Yeah, exactly.
So Galena then, just for people who are maybe new to America's Gold and Silver, is Galena then the flagship? How should people think of that? It sounds like it is.
And 100% is. Galena is our flagship in the US. And then we've also got a flagship operation in Mexico. We've got two, but Galena is predominantly our biggest and the one that's going to continue to grow. While don't underestimate Mexico. We had a solid year at 1.2 million. It was a record year for ourselves. And one thing I want to touch on and how these things happen, you've got an asset that's been starved for capital for so many years. And I've talked about that quite a bit of times here. But safety matters in our mines. You look at our mine. The year in 2024, we had 10 lost time accidents. That's a lot of people not going home with their body intact with broken arms or whatever occurred in the mine that they had an LTA, a lost time accident. Tomorrow, I'm flying to the mine and I'm excited to meet with all our miners first and foremost and the media. And we're talking about an accomplishment we've done. We're going 365 days tomorrow without a lost time accident. That is a major, major swing and shift in safety and mentality right from the board level down. From our board of directors to the executive team to the management team, we are all very committed to sending our miners home safely to their family in the US, in Mexico, and I'm certainly proud to be there with our team celebrating 1 year without a lost time accident tomorrow. So that doesn't happen by luck. So when people say, well, how are you going to improve the mine? How's it going to become more efficient? The first thing you start with is safety. You deploy the right message in safety and you follow through with it. And then good things start happening. And that's what we're seeing at Galena. The things that we're doing with the money we're doing, Adrian, are specific to infrastructure. We've got mines that have been around for 100 years, but the infrastructure is quite old. So what we've managed to do is our shaft, our main shaft, our Galena shaft, it was skipping at around, I'm just going to use some technical numbers, around 40 tons per hour. We replaced the top motors on the hoist. And by replacing those from 1,750 horsepower to 2,250 horsepower, we've actually doubled the speed of that motor. So by doing that, we've gone from 38 tons per hour to about 80 tons per hour. What that allows us to do is go up and down that shaft much more fast, moving the rock, moving the ore tons, moving the waste tons. And that was always a bottleneck at our mine. Our mine struggled because we could only move around 500 to 600 tons of rock a day. When we're done with the shaft improvements, we'll spend $8 million, but we'll be able to move 1,800 tons a day with one shaft. And as I was explaining, we got two other ones on either side that we've consolidated. So it's a much bigger system. The other things that we're going to do, Adrian, that are very important to our success are changing the mining method. For 100 years at the Galena mine, everything has been done with handheld jacklegs. So you think of a miner. I started mining 40 years ago in Timmins, Ontario. I started with a handheld jackleg, drilling 30, 40 holes, drilling and blasting. We're still doing that in our mine. We are shifting that to a long hole technique, which is much more modern, it's safer, much more efficient, and it's what our neighbors are doing. Our neighbors are already doing it very successfully. We haven't had the money to do it, the team to do it, and now we're changing that and leading this with an aggressive force because I'll give you an example. We took out a stope last year, our first long hole stope. It was 7,000 tons. We mined that in 28 days. Had we done conventionally with jacklegs, that would have taken us 12 to 14 months. So this is how much quicker we can get the rock out more efficiently, more safely. Instead of doing 30 to 50 ton blasts in the mine, we're doing 7,000 ton blasts. So by changing the mining method, improving the infrastructure in the shaft, buying brand new equipment, we're revitalizing this district altogether.
Well, it speaks to the experience and, frankly, the leadership of the company, your safety record, as well as just how you're approaching the mining method. How interesting. Again, speaks to experience there, which you have, of course, with Klondex Gold. Now, as we wrap up, Paul, what is your message to investors? Where is this going? What do you want them to know about America's Gold and Silver?
Yeah, look, one of the things that's very important that differentiates us, we're extremely excited about where silver is going. Silver prices are peaking. Are they done? I doubt it very, very much. I think given the demands we have globally and the shortfall in those demands, silver at $100 to $150 an ounce is very, very real. One of our differentiators is the fact that we do produce copper, we do produce lead, we do produce antimony. At the moment, we're the only U.S. antimony producer at the moment. There are others coming on and we welcome them all. The more the merrier, because it's all needed for the U.S. We need 50 million pounds of antimony a year. We import it all in the U.S. It's a very important critical mineral. We just signed a joint venture with U.S. Antimony to build a new facility in Idaho. That's going to be a game changer. We're going to be able to produce domestically antimony. And for our shareholders, it comes at no cost. We're already producing it. We're shipping the product up north to Canada. But rather than shipping it up there and getting paid a fraction of it, we'll get spot market for antimony. That's a complete game changer for us and our shareholders. Not only do we take advantage of the great silver prices, but we start to take advantage of copper that we weren't paid, gold that we weren't paid, and antimony at market prices. So the message I have is keep a close eye on what we're doing on production guidance, on our drilling, because we're going to be drilling extensively and aggressively in these districts. And we're already very excited about some of the results we've had, and pay close attention to the byproduct credits because they're real.
And Paul, is this on the Toronto Stock Exchange, TSX Venture? If people want to invest, where do they go?
Look, Adrian, it's a great question. In fact, I was recently asked to buy our ticker because it's such a popular, patriotic ticker. In the New York Stock Exchange, our ticker is USA.S. On the Toronto Stock Exchange, we're USA.TO. So great ticker names, easy to remember, and please pay close attention to us.
Fascinating and exciting. Paul Hewitt, Chairman and CEO of America's Gold and Silver. Thanks for joining us and sharing what you're working on the podcast.
Thank you very much. It's good to see you, Adrian.
And thank you once again to America's Gold and Silver for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit americas-gold.com. Turning to the website, Pentagon sought fresh supply of 13 critical minerals day before Iran attack. This is Reuters via mining.com on March 4th. The U.S. military asked mining companies on Friday to help boost domestic supplies of 13 critical minerals used to make semiconductors, weapons, and other products, a document reviewed by Reuters showed. The request, the day before the U.S. and Israel launched strikes on Iran, is the latest example in recent weeks of Washington's push for more access to the materials used widely in warfare. The Pentagon asked members of the Defense Industrial Base Consortium, or DIBC, a group of more than 1,500 companies, universities, and others that supply the military, for proposals to be submitted by March 20th for projects that could mine, process, or recycle select minerals, the document showed. There was no immediate indication whether the timing was intentionally coordinated to coincide with the start of the strikes on Iran. The list of the 13 minerals sought include arsenic, bismuth, gadolinium, germanium, graphite, hafnium, nickel, samarium, tungsten, vanadium, ytterbium, yttrium, and zirconium. The U.S. is reliant on imports for most of the 13. China is a dominant global producer of all of them. The Pentagon asked for detailed information on the costs, including labor and material, needed to build a mine or processing facility. Projects could be awarded development funds ranging from $100 million to over $500 million, according to the request. The document did not specify why only those 13 minerals were chosen. Some, including germanium, graphite, and yttrium, have been subject to export restrictions by China, the top global producer. Yttrium shortages especially have set off alarm bells throughout the aerospace industry. One of the 17 rare earths, yttrium is used in coatings that keep engines and turbines from melting at high temperatures. Without regular application of these coatings, engines cannot be used. The White House, DIBC, and Pentagon did not immediately respond to requests for comment. So, fascinating story there from Reuters on March 4th, and we have another story on March 5th from Bloomberg via mining.com. U.S. Defense Department seeks information to expand metal stockpiles. The U.S. Defense Department is seeking information for the potential stockpiling of 5 critical minerals as the country steps up efforts to reduce risks in the supply chain and bolster domestic feedstock. The Defense Logistics Agency on Wednesday issued notices seeking information for lithium, nickel, tin, chromium, and tellurium, respectively. including details of interested vendors, product specifications, sources of materials, and market conditions, according to notices published on the website Wednesday. The DLA is responsible for managing the National Defense Stockpile, which secures metals for U.S. military needs. One wonders if this second story is a consequence of the first story. In other words, that the Pentagon asked members of the DIBC, or Defense Industrial Base Consortium, for these metals, and that the Defense Logistics Agency is now helping find them, but they are different metals. Chromium and tellurium, tin, and lithium were not mentioned in the first article. It continues, the DLA is responsible for managing the National Defense Stockpile, which secures metals for U.S. military needs. The Pentagon's request came as the procurement of metals has become a political priority for the U.S. in order to slash reliance on Chinese supplies. Most recently, the White House announced Project Vault, a $12 billion stockpiling initiative for the private sector. The agency said it is making inquiries ahead of the potential acquisition for 550 tons of lithium carbonate, 3,500 tons of nickel, 1,978 tons of London Metal Exchange grade tin, 37 tons of tellurium, and 4,500 short tons of chromium. It also made inquiries about the reprocessing or remelting of 1,978 tons of tin ingots affected by so-called tin pest, a phenomenon where the metal degrades into a powdered form in cold temperatures. That amount of tin would cost nearly $100 million based on LME prices. The DLA said the notices are for planning purposes only, and the deadline to submit the response is by March 19th, adding that companies responded should not expect to receive feedback regarding submissions. So quite interesting. So that's for March 19th, and the other story, the deadline is March 20th. It is tempting to see a kind of relationship of some kind there. Not exactly sure how that all works out. Let's continue. China's 5-year plan to target fixes to commodities supply. This is Bloomberg News on March 2nd via mining.com. Chinese leaders will launch a pivotal 5-year plan this week that'll help shape global commodities markets through the end of the decade. Their fixes targeting supply will be as important as the impact of their decisions on demand. As the world's biggest buyer of raw materials, China's annual GDP goal plans to stimulate the economy, and any steps to support favored sectors from clean energy to artificial intelligence should give relatively straightforward clues on where consumption is likely to expand. But the supply side is more complicated. Beijing wants to strengthen resilience in some areas and ease cutthroat competition in others. At the same time, industry is being retooled for a green transition that calls for peak emissions by 2030. And a follow-up story, China to strengthen development of rare earth industry over 2026 to 2030. This is Reuters via mining.com on March 5th. China said on Thursday that it would strengthen the competitiveness of its dominant rare earths industry in the next 5 years, according to its 15th 5-year plan. The world's largest producer of various critical minerals crucial to energy transition also said it would enhance and improve its export control systems. End of the story. Continuing on, China's central bank extends gold buying to 16th month. That is Reuters via mining.com on March 7th. Continuing on, another percolating story here. It's tempting to see this as actually quite a large story behind the headlines. We have an update. China's state iron ore buyer summons traders on BHP restrictions. This is Bloomberg News via mining.com on March 5th. China's state-backed iron ore buyer has summoned traders and urged them to refrain from buying new BHP Group cargoes to sell to buyers in the country after they were found to be flouting a restriction on the purchases. China Mineral Resources Group Company has signaled it will toughen enforcement in conversations with domestic and foreign traders in recent weeks, according to 2 people familiar with the matter. The group doesn't have formal authority over Chinese steel mills that are taking the iron ore, but the order is effectively binding due to the body's political clout. CMRG and BHP have been caught in a months-long standoff in talks for long-term contracts on behalf of China's mills. The state-backed buyer first ordered steel producers to stop buying Jimblebar blend fines, a type of iron ore, in September. It subsequently restricted purchases of all new products which are denominated in dollars from the company, and then Jinbao, another variety of the steel-making ingredient. So, kind of seems like China's not taking no for an answer. That either you're going to sell this to us in yuan or you're not going to sell it to us. Incredibly. So BHP continues to hold out on that. And an update on the Belgian museum where Cobalt Metals is trying to get the documents from the Belgian museum, who of course has all of these records from the Congo. Cobalt wants the data. Here's the story. Belgian museum, U.S. mining company at odds over colonial-era Congo. This is Reuters via mining.com on March 4th. A U.S. mining company backed by billionaire Jeff Bezos and Bill Gates is in a tangle with Belgium's Africa Museum over who should digitize antique maps of what is now the Democratic Republic of Congo in the museum's archive. Mining startup Cobalt Metals said it had offered to support the DRC in digitizing the colonial-era archive stored on museum shelves stretching some 500 meters and containing millions of documents that record how Congo's mineral wealth was mapped and exploited. Quote, "We scan, we digitize the documents and make them accessible to the public immediately," Benjamin Katabuka, Director General for Cobalt Metals in DRC, told Reuters. Quote, "This country needs more investment in exploration, and we need the data to be available to the public to make that happen." End quote. The Belgian Museum, backed by Belgian authorities, has refused, saying it already has a separate project with the DRC to digitize the data, backed by the European Union. Quote, "We cannot delegate the management of collections to private companies. It would go against all scientific and institutional ethics," Museum Director Bart Ouvry told Reuters. Scrolling down, Katabuka said the request for access to the archive was made by the DRC government. Quote, "Cobalt is coming to support the project technically and financially." And then we hear from the museum director. Ouvry said the museum is working with Congo's National Geological Service to digitize and share the geological archives in a project expected to take up to 5 years. Data would be available in both countries, quote, "in accordance with Belgian and European law," he said. Quite an interesting story over there. Continuing on in the Congo, U.S. struggling to de-risk Congo's war zone minerals even after pact. This is Reuters via mining.com on March 2nd. The U.S. has made progress in its push to prize Congo's strategic minerals from China's orbit, but conflict, contested licenses, and compliance demands are still slowing Washington's advance into a region its rival dominates, diplomats and industry officials said. Democratic Republic of Congo, which holds the largest cobalt supply and rich copper and lithium reserves, is central to the U.S. push to cut the West's reliance on China for rare minerals. Scrolling down, one U.S. diplomat said Kinshasa is deliberately slowing new deals to push Washington to increase pressure on M23 before any further steps are taken. Reuters could not independently verify the claim, but it sure rings true, doesn't it? Quote, "The agreement has its own rhythm, a period for receiving offers, a period for negotiation," the official said. Rwanda, which denies backing M23, did not immediately respond to requests for comment. Very interesting as we continue. Codelco, Microsoft team up on AI and analytics initiatives, and this is by a staff writer at mining.com. Codelco is teaming up with Microsoft on various initiatives in artificial intelligence, advanced analytics, automation, and digital security to improve its copper mining operations. So we see AI technology continue to be used and implemented in the mining sector. Another headline, LME launches consultation for proposed rules on position limits. This is Reuters via mining.com on February 27th. The London Metal Exchange on Friday issued a consultation paper on proposed changes to rules on position limits to comply with a directive from Britain's financial regulator. The Financial Conduct Authority currently sets and administers position limits in commodity derivatives to prevent market manipulation and abuse, but this responsibility will pass to the trading venues themselves from July 6th. So consultation is beginning on position limits, interestingly. And just a few more headlines. Lithium prices jump after Zimbabwe bans concentrate exports. That's Bloomberg News via mining.com on February 26. Lithium prices and shares surged after Zimbabwe, one of the world's top producers, suspended concentrate exports, fueling fears that global supplies of the battery ingredient will tighten. Lithium carbonate on Guangzhou Futures Exchange rallied 5.4%. Shares of lithium producers from China to Australia and the Americas also jumped. Interestingly, we had this follow-up story on the following day. China's Yawa starts building lithium sulfate plant in Zimbabwe. This is Bloomberg News via mining.com. Sichuan Yawa Industrial Group said it has started building a lithium sulfate plant in Zimbabwe as the southern African country pushes mining investors to upgrade their processing operations. So Zimbabwe getting serious about processing locally. And final headline, Malaysia renews Lynas Rare Earths operating license for 10 years. and that is Reuters via mining.com on March 2nd. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. And keep in mind, this is 2 weeks now since our last price. The U.S. 10-year bond is yielding 4.12%. That is 0.08% higher, so not a huge difference. The UK 10-year gilt is yielding 4.59%. That is 0.28% higher, so more than 0.25% higher the yields on UK 10-year bonds. Italy's 10-year bond is yielding 3.55%. That is 0.23% higher. France's 10-year bond is yielding 3.48%. That is 0.21% higher. And Germany's 10-year Bund is yielding 2.85%. That is 0.15% higher than 2 weeks ago. Japan's 10-year bond is yielding 2.18%. That is 0.08% higher. And China's 10-year bond is yielding 1.81%. That is 0.02% higher. So bond yields higher after 2 weeks, in a sense, no longer seen, at least in terms of this current war in the Middle East, as a place of safety. Yields are going higher. Perhaps the real reason is a concern for inflation. With energy prices going higher, perhaps 10 years out, traders want more of a yield. Turning to precious metals, gold is trading at $5,176.50 per ounce. That is $18 lower than 2 weeks ago. Silver is trading at $88.41 per ounce. That is only 12 cents higher than 2 weeks ago. Platinum is trading at $2,164.70 per ounce. That is $2 higher than 2 weeks ago. And palladium is trading at $1,694 even. That is $81 lower. So palladium continues to be the odd metal out. Quite interesting. Hardly a change, though, with gold, silver, and platinum over the last 2 weeks. Turning to industrial metals, copper, a similar situation, trading at $5.77 per pound. That is 2 cents lower from 2 weeks ago. Iron ore is back above $100 per metric ton at $101.91 per metric ton. That is $2 higher than last week. Aluminum has jumped at $1.54 per pound. That is 14 cents higher than 2 weeks ago. Lead edges lower at 88 cents per pound. That is a penny lower than 2 weeks ago. Nickel is almost even at $7.89 per pound. That is 5 cents higher than 2 weeks ago. Tin is trading at $22.71 per kilogram. That is $1.59 higher than 2 weeks ago. Cobalt is unchanged at $25.53 per pound. And lithium is higher at $22.37 per kilogram. That is $1.55 higher than 2 weeks ago. Uranium is trading at $85.95 per pound. That is $4 lower than 2 weeks ago. And finally, zinc edges lower at $1.51 per pound. That is a penny lower than 2 weeks ago. So quite interesting zooming out. Actually, how little has changed from before the beginning of the war in the Middle East to today. How little has changed in terms of the metals, and those are your metal prices. Coming up, I'm very pleased to welcome Frik Els, editor-at-large at mining.com, back to the program. Frik puts out regular articles with charts that are super fascinating. This time we go into battery metals, electric vehicles, batteries, and the whole ecosystem. My questions came from all sides, and Frik could answer all of them. So an impressive interview with Frik Els if you want to learn about the battery metals market and just what is going on with batteries and electric vehicles globally. A fascinating discussion. So I hope you enjoy it, and I will see you on the other side. Join us today. I'm very pleased to welcome back to the Northern Miner podcast after far too long, Frik Els, editor-at-large at mining.com. Frik, welcome to the show.
Hi, Adrian. Great to be here.
Well, I'm just excited to have you, Frik. You've written some pretty interesting articles there on mining.com, often accompanied with a chart. And one of them in February, I found super interesting. It was on EVs, electric vehicles, and battery metals, and really the return of battery metals. This is something I've been noticing in the price. We follow the prices here weekly, and cobalt, lithium, even to a certain degree, nickel are perking up, and there does seem to be kind of a quiet return. How would you characterize it? What's going on with battery metals, big picture?
I think that's a good way of looking at it. I mean, the slump of 24, 23 was pretty deep. I mean, you had lithium coming off 80% from the peaks just the year before. Cobalt at one point went to a record low on an inflation adjusted basis. And nickel didn't go through quite those wild swings, but nickel was pretty depressed as well. And then early last year, about a year ago, the DRC did the export quota thing and just immediately made a huge difference. So cobalt, which is almost being written off as a battery metal, is definitely back. Prices having, more than doubled and seems to be staying there. It's not a spike. And then before too long, we're back to where we were. Same for lithium. I think the overproduction is kind of worked its way through. And nickel, Indonesia, I mean, they've had this strategy for a long time now. First of all, they want to get investment inside the country for downstream, for smelting, etc. But they also have long tried to manage their exports. They don't want to export ore, or they have quota systems for the miners there. So that's perked up the nickel price as well.
Okay, interesting. And before we continue, have I identified most of the key battery metals, or I suppose it's in your list here, but would you consider those ones the main ones? You have graphite and manganese as well. Should we be thinking of graphite and manganese on the same plane, say as cobalt, nickel, and lithium? In a sense, are those the main battery metals?
Those are the main battery metals, yes. Graphite, I think at last count, about half of the graphite that goes into EV batteries are synthetic. So graphite is a battery metal story, but it's less of a mining story. And it's also completely dominated by China, much more so than the others. Manganese is a high volume, almost a bulk mining project. So what goes into EV batteries is not such a huge part of the overall manganese market, whereas cobalt, lithium, and nickel as EVs is now the main driver of growth.
So, in a sense, what has changed in the last, say, year or since these metals started to bottom out? I mean, we've seen big picture, we've seen most of the metals go up, right? It almost seems like a general inflation story to overgeneralize.
Yeah.
Nevertheless, as you point out in your article, it looks like EVs, electric vehicles, are starting to catch, so to speak. They're starting to get more popular, and the bearish calls on electric vehicles from a few years ago are it's starting to turn around that story, isn't it? So do you see this as an electric vehicle story or a general inflation story? Maybe both? How do you see it?
See it more as a commodity pricing story. I mean, the cobalt situation, it wasn't all the great demand is pushing up prices. It was more of a supply thing. Same with nickel to a degree, same with lithium. Some of the supply went off the market. And for lithium, it's also, I think, energy storage is going to become a bigger part of the lithium market. For renewable energy storage, I mean, those batteries, you could sell 1 million lithium ion batteries in EVs, and it could still be much smaller than, if you're building 50 energy storage projects. Of course, those are swinging towards LFP, lithium ion, as opposed to NCM. So you're not going to put cobalt and nickel. You're not going to have NCM batteries to store energy, next to your solar plants. But for lithium, yeah, that's working in its favor. As for the EV market, 2025 was another big year. If you track the battery capacity that rolled onto roads for the first time last year, it was the first year above 1 terawatt hour. 1 terawatt hours. So just the scale of the EV market is so much. I mean, that's 5 times what it was in 2019, at least. But I do think we are going into more of not a plateau, but I think the growth rates that we had will not be sustained just because of the installed base is now so large. So in China, I mean, it sells more electric cars than the rest of the world combined. The growth there is slowly beginning to not peter out, but it's not the 30% plus year-on-year growth rates that we're seeing. We can't really see that because the market can only be so big. So I think things are plateauing a bit in China or slowing down slightly from what frankly was a breakneck pace before. I don't think the government there is too unhappy about it because what they don't want is these cutthroat price wars. Before you know it, you have started getting bankruptcies and that kind of thing. So they are actually telling EV makers, you can't be selling these cars at $5,000 because all your part suppliers are going to go out of business and that kind of thing. So that is part of it. They call it involution, or they want to stop the industry from involuting, if that is a word. But let's go with it. And then in the US, of course, you had the relaxation of the emissions rules and regulations. So I think there's a bit of a slowdown in the US as well. Actually, last year, Europe became the fastest growing EV market, even faster than Asia and much faster than the US. To sum up, there's still growth there, but just because in volume terms, the market is already so big, if the prices rise, it's still, a growing market for suppliers of battery metals.
And you mentioned NCM and LFP batteries. So maybe some of our listeners are unfamiliar, and even myself. Like, I'm familiar with these different kinds of batteries, but from what I understand, what you said, in a sense, there's a bit of a movement from NCM, which I assume is nickel, cobalt, manganese, to LFP, which is, I assume, lithium, iron, and is that phosphorus?
Phosphate,
I don't phosphate.
Yeah.
So what's going on there? Why is this moving, and does this hurt cobalt? Can you just kind of characterize this?
Cobalt is the most expensive part of a NCM battery, and the automakers have been thrifting it out for as long as they've had to buy cobalt. They've been trying to buy less of it. So there's been a move to a high nickel NCM battery. So in the very early days, it was a ratio of 1-to-1 nickel, cobalt, manganese. Now it's 80-90% nickel, and then the rest shared between manganese and cobalt, and as little as possible cobalt. So that's one thing. The other side of that is the LFP, move to LFP, which in China has 70% of the market already, which just simply cuts out nickel, cobalt, and manganese. So that is the big price advantage that China has at the moment. They have all the factories. They're trying to build outside. Tesla has a LFP factory in Germany. So, and that is growing from the China base. It's it's kind of expanding. Everybody wants LFP because it makes it cheaper to manufacture, etc. So that has been a huge trend for the past 3, 4, 5 years, I would say, and that definitely has an impact.
Interesting. So if I was to summarize the takeaways from what you said, in a sense, this is what we might call an R&D or science and technology story of the battery technology improving in order to use cheaper metals, so to speak, like iron, which is ubiquitous, more widely available and cheaper. Is that basically why this is happening?
Yeah, totally. I mean, there are disadvantages to LFP when comparing with NCM. I mean, it's less energy dense, but the Chinese manufacturers like BYD, they make their own batteries. They switched to a all LFP lineup quite a few years back now. That has been kind of the secret source of the Chinese manufacturers developing LFP to compete with NCM, which it didn't really compete as well before. But now, the gap has closed quite a bit, not entirely. So you'll see your high-end OEMs continue to use NCM. It does have these energy density advantages, etc. And if you're building a large SUV or maybe a range extender or SUV, you can't make the battery too big and go for a LFP. You have to try and keep the weight down. So there's still trade-offs there. But LFP has changed the structure of the market. I mean, that it goes without saying. But not that NCM is going to go away, but LFP will continue to grow probably at a faster rate. So the next step, you save some money going from NCM to LFP, but you can save even more money if you then go to sodium ion batteries, which is the next development. Then you don't need lithium, you just need sodium, which is cheap and plentiful. So, the quest to use the cheapest, most widely available metals is not going to stop for the EV makers.
It's funny, I was going to ask you, so has the market settled then on LFP, except for certain circumstances? But it sounds like, based on what you just told me, the innovation continues, doesn't it? And is this innovation, say with these sodium batteries, is this all coming out of China?
Yeah, it's they're the ones commercializing it. Many of these cathode chemistries, it's been in the lab for decades, but it's one thing to have it in the lab. CATL, which is the biggest EV battery manufacturer by a long shot, they are developing sodium ion. Now, the downsides of sodium ion is similar to the downsides of LFP versus NCM, just to a greater degree. So sodium ion is not going to compete with NCM batteries, but it'll eat a little bit into lithium, but also up to a point. I mean, sodium ion is probably more suited for like energy storage than EVs. They've been promising EVs with sodium ion batteries for a while now, but that's probably just going to be very low end, tiny range kind of urban runabouts. That'll be sodium ion.
Super interesting. So it's like a spectrum based on your needs and how far you want to go, and I guess your use case. Quite fascinating. Now, in terms of, say, these EV makers, you mentioned CATL. So we see CATL in the news a lot. They are Chinese, are they not? And do they have a relationship? I thought BYD made their own batteries, but is that wrong? Like, do they get and what's the relationship, say, between CATL and BYD, if any?
Yeah, BYD manufactures their own batteries. I think they might have very old contracts where they get some from CATL, but I don't think so. That is also one of their strengths. Of course, that's why they're now by far the biggest EV maker, is the fact that they can integrate these operations, cut costs along the way. But CATL, they supply just about everyone from Tesla. I'm pretty sure BMW or Mercedes-Benz, Stellantis, I think most of those do have contracts with CATL. And it's just scale. I mean, they have about 30% of the global market when measured by battery capacity employed.
Okay, super interesting. And in terms of the, for lack of a better term, quality of, say, a BYD battery versus a CATL battery, is that something that people have an idea about? Like, in a sense, is a BYD battery considered better, or is it considered not as good? Do you have any sense of that, or is that just kind of a bit of an unknown?
I can't really say that. I mean, yeah, I think at the end of the day, the battery has to perform in a certain way. And depending on what vehicle you're making, you kind of adapt the battery for that. But yeah, I don't think that in terms of quality or durability or anything like that, I don't think there's really a difference. Yeah.
Okay, fair enough. So all these batteries work. We know that
Yeah,
much.
yeah.
Okay, very good. Okay, so another question relating, say, to the auto market then, and say the Western auto market versus, say, the Chinese electric vehicle market. You mentioned, say, BMW, maybe they get their batteries from CATL. Now, when we hear, say, you mentioned earlier that in Europe, EV cars are growing at, the fastest clip, let's say, compared to, say, China or North America, for example. Is that a BYD story? Like, is this a cost thing where people are just starting to buy this thing? Or is this kind of more spread out, and to call it a BYD story is unfair?
I think definitely the Chinese vehicles coming into Europe, of course, they're shut out of the US completely. Canada only recently said you're allowed to bring in, 49,000 of them. So yeah, Europe is really the test case of how successful China is going to be in exporting. Because they have overcapacity, they have to find new markets, which they are doing where they can. So yeah, that plays a part. But I think it's also, finally we're seeing the Western automakers kind of catching up with, built for purpose EVs. They're not just taking one of their older models and slapping on a battery. These are now, specifically designed. So there are some, exciting stuff coming out. They've also, been able to lower the costs. The cost differential is not that big anymore. It's still, the Chinese vehicles are still amazingly cheap for what they are. They're good quality, well spec everything, and then they cost 10K less than the equivalent in the West. But that gap is also closing. So I would say, yes, China's entry into the European market is making a huge difference, but it's not the only thing that's going on in Europe.
I've been in Europe 10 years now, and I don't know if I've ever seen a BYD car. I'm sure I have, but it's not like I've noticed it though. And it's not like I'm looking either, but it is remarkable because I think if I did see a BYD car, I'd take a second look and go, oh, there's the famous BYD car. But so anecdotally, it is quite quiet, so to speak. But it doesn't mean there aren't kind of pockets or of markets where maybe they're being, more widely distributed, and maybe that's not in capital cities, for example.
Yeah, the other thing in Europe as well with the tariffs, which is not, it's not nothing, but it's not very onerous, the tariffs that they have to contend with. But for reasons only Brussels probably knows, the plug-in hybrids are not subject to these tariffs. So while fully electric vehicles, yeah, they're making their way to the shores of Europe, but it's plug-in hybrids is where they have the real advantage because there are no tariffs. So sales of those have gone up in Europe, Chinese-made ones, quite a bit more than fully electric. I mean, these trends change all the time, but if you want to bypass taxes, you find ways. So, and BYD is actually the share of plug-in hybrids in their overall sales. The share has been going up, and it's now more than 50%.
Wow.
Yeah.
Now, the hybrid issue is actually a super interesting, and I'd actually argue under-discussed issue considering the number that you just presented to me.
Yeah.
And so, I mean, what is your sense? I mean, because a couple of years ago, I remember in the EV discussion, which I haven't paid super close attention to, but as one does, you read the headlines, it seemed like hybrids were starting to look like the solution because of all of the range anxiety, which I feel is starting to be solved with technological progress, at least what I see on X and, the latest developments. I don't know if you just saw the issue with the battery that charges in like 5 minutes or 10 minutes. I don't know what's true anymore on social media, Frik. So maybe that's, but all to say, what's your sense of the hybrid situation? Is it the next big thing? Is it the big thing right now? Or is battery technology starting to progress enough where it's not quite the thing that people thought it was?
I think it all really depends on where you are. In Europe, just the way the infrastructure is there, you probably have more charging points. It's not these vast distances. So, hybrids maybe make less sense there. But for places like North America and many other places in the world, I think the range issue is still an issue. You can also look at range extenders, which is it's a hybrid, but the internal combustion engine never drives the wheels. You have an internal combustion engine, but all that does is charges your battery. Now, some of these range extender vehicles, you can go almost 2,000 kilometers, 1,500 kilometers on a single charge and a single tank. Now, that sounds to me as the perfect solution. You can go on your holiday across the US. You never have to worry about finding a charging point. And if you do, and then you're good to go for another 1,500 kilometers, but you can just fill up your tank and go that way. And because it's not driving the wheels, it's, can be a smaller engine and it's running continuously. So it's not going to use lots of gas either. it just takes away all the range anxiety which you might still have. So I think we're going to see much more of that in North America, whereas I think in China and China, that trend is, I think, is close to being played out because plug-in hybrids were growing much faster sales than full electric, and now full electric has kind of taken back the momentum, so to speak. But that is China and Europe, not necessarily North America.
Such a dynamic market, isn't it? And, we're probably just waiting for the fallout now from, oil prices almost doubling there in a couple of months. And then what does that do, right?
Yeah.
So returning to the metals, we listed 5 metals there. Is there a metal that you're more concerned of, or tell us about the metals? Like, I guess each metal has its own story, doesn't it? Nickel, Indonesia, lithium. Is it something that can be discussed as a whole, or do they need to be parsed out and discussed individually?
I think I guess they go together. So one has an influence on the other. But yeah, it's all very different markets, different concentrations in different places in the world. I should just bring in rare earths for a moment. If you're talking about concerns or dynamics, that is, of course, a very dynamic market at the moment. And the rare earth permanent magnet motors in EVs, they are, I think, 9 out of 10 EVs have a rare earth permanent magnet motor, at least one of them. So that is also the biggest demand story for rare earths. That again is a completely different market to lithium. I mean, you would know about, China trying to control rare earth and succeeding at controlling global supply of rare earth. And, they can kind of pull the plug if they would want to because they control 90% of the magnet making and the rare earth metal making, which you need before you get a motor. Yeah, lots of moving parts.
Indeed. I was thinking about that when you hear about, again, reports of Chinese oil tankers leaving the Strait of Hormuz, and you wonder if they're just daring anybody to sink that oil tanker and just waiting for, we might have to cut off your rare earths again. Is there any market, though, that stands out, like lithium? I guess we hear this supply demand story. We're oversupplied. Now it sounds like there's going to be a tightening of supply. Same with nickel. I mean, is anything kind of standing out to you in terms of the battery metals?
I would say lithium because it has this other aspect to it of energy storage, which could be, it's not inconceivable that energy storage becomes a bigger demand driver for lithium than EVs. I think the lithium market is interesting. I mean, the prices have gone up substantially, but, I don't think the market is necessarily out of the woods completely yet. We're still nowhere near where we were, and I doubt we're ever going to see that because there are quite a few lithium projects on the go. Whereas nickel, I think the fact that Indonesia for nickel and the DRC for cobalt, that is such an established supply chain now. I'm not sure much is going to change there. But yeah, I think lithium is going to be interesting to see where that goes. Rare earth, I imagine, will be in the news quite a bit. It has been and will be for quite a while. I don't think China is necessarily, they have the capability to do this now, but I don't really seeing them using rare earths too much as a weapon. And, when they have these shots across the bow, I mean, the West has now started to respond. I mean, the US government is investing in rare earth projects and rare earth companies. Around the world, there is a huge emphasis now to, set up alternative supply chains. So, yeah, that kind of thing is definitely happening.
Any final thoughts, Frik, as we wrap up? Where do you see things going? Anything on your radar as we look ahead?
I would say, the overall market is going to keep growing, but probably at a slower pace. But we are now in a different world already. Almost 30 million electrified vehicles were sold last year when you include conventional hybrids. So I think the technology in EVs is going to continue to change. And I mean, you can look at oil prices in the short term, but I think the switch to electric vehicles from combustion engine vehicles, that's not going to stop. We're not going to suddenly give up on a switch to electric vehicles, even though it might happen a little bit slower in some places in the world. I guess everything now has a geopolitical component to it, and that is very hard to predict. So, vehicles, automobile industry is so vast, and there's so many things impact on it. So, I hate to say it, but I think we are going to be hostage to what happens geopolitically in the world. One supplier of heavy rare earths to China is Myanmar. There is an ongoing insurgency and civil war there. If something happens there, it's not on everybody's radar, but it could have a huge effect on the rare earth market. Let's say something goes very wrong in the DRC and it has a huge impact on cobalt. I just think nowhere is the world of mining immune to geopolitics. And unfortunately, we're living in very interesting times when it comes to that.
As the saying goes, Frik Els, editor-at-large at mining.com. Thank you for joining us and sharing all of your insights and perspectives on this week's Northern Miner podcast.
Thank you very much. This is great.
Thank you once again to America's Gold and Silver for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit americas-gold.com. Thank you to Frik Els for appearing on this week's program and sharing all of his super interesting research on electric vehicles and battery metals. And thank you, dear listener, for continuing to join us. I hope I have brought you up to date on the last 2 weeks. Thank you for your patience. If you want to help out the podcast, please leave us a review in the Apple Podcast directory. Share it with your friends. And until next week, take care.